Hello everyone, welcome to another episode of the Technical Analysis Training Series for Beginners. I'm really happy you're here because today we're going to learn one of the most commonly used but most misunderstood tools in technical analysis, and that is none other than the trend line. You might think you know how to draw a trend line, but let me guess, you just connect 2 points together and say you're done, right? Today we're not just going to draw lines, we're going to actually gain mastery over it. So grab your notebook and write down the points I'm going to tell you so we can make the best use out of trend lines. Let's go ahead and get started. But before that, if you're new to our channel, make sure to subscribe, like the video, and hit the notification bell so you're the first to know whenever we post a new video. On our channel, we teach technical analysis for beginners, and you're watching one of the videos from this exact playlist. We post daily coin analysis every other day and introduce 4 coins on our Telegram channel and other social media that could potentially have the highest return on that day. All right, I won't make the intro any longer. Let's get to the video. So what is a trend line, guys? It's a diagonal line that's drawn on the chart. Usually it connects one of these two, either higher lows in an uptrend or lower highs in a downtrend. Trend lines help us better understand the strength and direction of the market movement. If I want to simplify it for you, for us, a trend line is like a slanted support and resistance line drawn on the chart. Price reacts to those points. For example, we generally have 2 types of trends, uptrends and downtrends. In an uptrend, like here, we're forming higher highs and higher lows, and we connect those lows to each other, and that forms a trend line like this for us, where the price hits it, reacts to it, and moves upward from that point. Now, if we want, we can also draw a trend line for the highs, which would look like this. Now, how do we even draw a trend line? Should we draw it from the body or from the wick? I'll explain all of that in the rest of the video. But to help you understand it better, I have to start from the basics and gradually go through every point with you. So don't rush. So we have 2 types of trends, uptrend and downtrend. As you know, in an uptrend, we form higher highs and higher lows. And if we want to draw it, it looks something like this. In a downtrend, for example, at the current price, Bitcoin is in a downtrend. We could say this is a downtrend, and its trend line would look like this. Now, depending on whether the price moves higher or needs to drop, this trend line of ours shifts a little. All right, that's our 2 trends. Now, how do we draw a trend line? Look guys, let's assume here that there's no trend line drawn and we haven't seen any of this. We find the spots where price hit and moved up. Where are they? Here's one, here's another here, and here. Now we connect the first place price touched to the last place it touched. Then we clean it up a bit. All right, let me remove those circles. So what do we say? We take the first and the last touch. We draw it from the body, not the wick. Why not the wick? Because if you draw from the wick, in some spots, you might enter a position too early and price might actually reverse and come back. Personally, I've had better results drawing from the body, so I recommend you do the same. So what did we say? We take the first and last touch. Now we clean it up. Now I drew it, and it turned out right. Why is it breaking out here? Sometimes the trend line we drew gets broken by price, and then comes back up, or it might even break and keep going down. I'll explain all of this later. Now, for example, here when it broke and came up, this is called a fake breakout. But let me tell you something. Let's say we didn't have the rest of this chart. If we didn't have the rest, our initial trend line would have come lower because the last touch we had was here. Sorry, my chart keeps refreshing. My internet is a bit weak. So keep in mind that over time, your trend lines become cleaner, better, and more accurate. So right now we have this kind of trend line here, and this spot is a fake breakout. Why do they do this? They do this so that emotional traders who trade without confirmation and think they're missing out fall into a trap and others profit off their losses. Who does this? Some millionaires who, honestly, this stuff doesn't matter to them. And these are the kinds of events that are really hard to predict. Very few people can guess this. Most of us don't know. And these events are generally unpredictable. So this was the uptrend part I told you about, what to draw. Now, can we also draw its top? Yes, exactly the same way. Where did we have a reaction? Here we had a reaction. There was a drop here and here. If this part hadn't formed yet until now and we wanted to draw the trend line, we would draw it from the body and it would look something like this. But since the market has updated and gone higher, the top that it hit, we draw the trend line here. We had this kind of trend line, and after that it broke, then it went up. Would we open a position here? No. Why wouldn't we open a position here? Because there's a point when we're in an uptrend and we're forming higher highs and higher lows, we don't open a position just with a break to the upside. Why? Because we call this kind of move trend exhaustion. And usually after something like this, it's a fake breakout. Of course, here we would miss this big move. Why? Because we're not future seers. We're just people who know how to analyze, and based on past events, we've learned some things, and based on those, we predict the future of the market around 50%. Based on the things we've learned, 50% or a bit more. So we're not psychics. And I personally wouldn't open a position here. Yeah, maybe after this break I might open a position, but not around here. Now, what's it like in a downtrend? In a downtrend, it's exactly the same. We take the first place where it touched and the last place where it touched and draw a trend line. Now here it's forming a high. If this high breaks above here, our trend line will change and move here. Okay, this was that point in the downtrend. Now about drawing trend lines, just one more thing. Sometimes, like for example here, when we drew this uptrend line, the highs and lows weren't parallel, but sometimes it happens that the highs and lows that are forming higher in an uptrend, or the highs and lows that are forming lower in a downtrend, end up aligning in parallel. If that happens, we use a tool called a channel. From the left panel, you click this, scroll down and click this option. For example, here we can now draw a channel. Why? Because the highs and lows being formed are more or less parallel. So we draw something like this. Exactly like this, the top and bottom form just like that. And as you can see, we have this center line here, which the price sometimes reacts to. What do we do with this line? Nothing. We don't trade using this line. I just wanted to tell you what this center line is and what it does. Usually halfway between the two lines we've drawn is an important level. 50% is a key number. We have this center line here, and as you can see, price has reacted to it in some places. Like here, it touched and reacted, or here, touched, or here, touched and reacted to the line. That's it for the channel. I told you to draw it. I told you what kind of trend lines to draw. I told you how many types of trends we have. I taught you how to draw trend lines. Now let's talk about the difference between support, resistance, and trend lines. Let me explain the difference between support, resistance, and a trend line. The trend line is basically our support resistance, but it's tilted, it's angled a bit. Is it more valid than support and resistance? No, it's not more valid. But still, just like support and resistance, it has its own validity. And there's a chance that price will react to it and bounce up. It's just that support and resistance are more significant numbers because price hits them more often, and throughout time, the chance of reaction to them is higher. But for example, when I draw a trend line like this here, this trend line in the future won't have any impact for us. But if, for example, here we had a top or a resistance, this resistance was touched here, we may need to adjust it a little. But it got touched here and then it keeps getting hit afterward, and the market reacts to that resistance again and again. So trend lines are less valid than support and resistance, but still important lines, areas we can rely on. This one also needs to be moved a bit higher. I missed it, sorry. Now I want to tell you how we can actually open positions with the trend. What was the point of everything I just told you? What benefit does it give you? How does it help you when you want to enter a trade? Guys, the most important thing when we're trading is knowing what trend we're in. If we're in an uptrend, forming higher highs and higher lows, we never open short positions while price is going up unless we get confirmation of a trend reversal. And same goes for when we're in a short, when we're in a trend, and also when we're in a short trend, we never open long positions until we get confirmation. And we actually enter trades based on that confirmation. There are two types of traders in this context. One type, when price reaches support or resistance, they say this is resistance, and they open a short right there. But the second type of trader, they wait for the break of resistance, and once it breaks, they open a long position. The method I've taught you and the way I trade myself is the second one. The breakout trader. We enter positions on a break of resistance or support, not just because price touches support or resistance. So what's the use of all this? Let's say we're in an uptrend and we're making higher highs. Some people, when price touches the bottom of the channel or trend line, they open a long and aim for the top. Or when price hits the top, they short it down to the bottom. Personally, I don't trust this method. I feel like price can hit our stop loss easily. Now, how do I trade and how I recommend you trade too? We're in an uptrend, forming higher highs and lows, right? And we can't say the trend has changed until a lower high or low forms. We're in an uptrend, we're drawing the trend line, then suddenly that trend line breaks. Do we open a position right there? No. When do we enter? This is an uptrend. We enter only once this low breaks. When that low breaks, that's when we know we're heading for a lower low. Let me tell you something. Right now, we have a high here, which becomes a resistance. In the future, that becomes a resistance. We also have another high here, another resistance. And here too, another resistance. Why? Because price hit it and reversed. In an uptrend, both highs and lows can act as resistance and support. But we care more about the low because we're watching for a break. This low is important. And if price had come up here, made a high, and then broke that low, we would open a short position in the uptrend after that break. So what did we learn? In an uptrend, while we're forming higher highs and lows, after the trend line breaks, we wait for the break of the previous low. And with a confirmation, very important, confirmation, with confirmation below that low, we enter the short, not just with a simple break of the channel or trend line, not just when one candle with a shadow breaks below. We don't open like that. The candle must close with its body below the line, below that low, not just a wick. Now let's look at downtrends. In a downtrend, we wait for the break of the upper trend line and then the previous high. Only after that high breaks, we can open a long. Again, only with confirmation above, with the candle closing its body above that level, not just with a wick. This is super important because if you only trade based on wicks and don't wait for candle bodies to close, you'll lose trades in maybe 70% of cases. Not 100%, but still. So be careful. Never trade just based on wicks. Make sure the body closes beyond the level. Now, I mentioned something earlier. I said trend exhaustion. We said we have two types of trends, uptrend and downtrend, right? So what is trend exhaustion? When we're in an uptrend, if the trend line we have in the direction of the trend gets broken, we call that trend exhaustion. Meaning what? If we're in an uptrend going up and the price comes and breaks the upper trend line in the direction of the move, we call that trend exhaustion. We don't open a position with that. In a downtrend, if price comes and breaks the lower line, the one in the direction of the move, again, we don't open a position with that. We wait for a trend reversal instead. This was another important point. Now, there are a few confirmations that we can use to enter positions. We have an indicator called volume. Go to Indicators, search Volume, and add it. It shows something like this at the bottom. I'll teach you everything about this indicator in detail in a separate video, but for now, I'll just explain briefly. It shows how much capital money entered on each candle. For example, on this candle, a lot of capital entered. The higher these bars go, the more volume they show. This volume helps us a lot. See, when we're in an uptrend, if volume increases during the trend, it means the trend is strong. Why? Because capital is increasing in the trend. Day by day, more and more capital is flowing in. So the higher the volume, the stronger the buying power, the stronger the uptrend. And the same goes for a downtrend. If volume increases in a downtrend, it shows that sellers are increasing, that the downtrend is strong. Pay attention. Some people might get confused here. They think in a downtrend, volume should drop. No, in a downtrend, volume should also increase to show the strength of the downtrend, that sellers are increasing day by day. And the opposite can happen too. We could be in an uptrend, but volume is decreasing. What does that mean? It means the trend is getting weaker. Buyers are fading out. That's where we wait for a break in trend line to open the best possible position. Because it shows that buyers are drying up and the chance of a trend reversal is increasing. And the same for downtrends. If volume decreases in a downtrend, that shows the downtrend is weakening. And that's where we wait for a reversal to the upside to open the best long position. So what does declining volume mean? Let's look at this zone from where this uptrend started, let's say here, to where it went. Let's look up to here. Let's examine it. Look at the volume. If we ignore the middle bars and just look overall, volume increased, right? So what does that mean? It means buyer strength is growing. Buyers are increasing. And as you can see, price moved up a lot after that. That shows that buying power is increasing. Now let me show you an example of a downtrend. From here, this is where the downtrend started. If we ignore this middle candle, overall volume decreased, right? So what does that tell us? That the trend is weak. And that's why I keep telling you in the daily analysis, don't look for short positions on Bitcoin for now. Because even though we're in a downtrend and making lower highs and lower lows, we as breakout traders are waiting for the reversal to uptrend. And only after the trend line and previous high break, we open our long position. That was the note about volume confirmation. And let me add, when we're in a trend and we want to reverse the trend, if volume also increases along with that break, that's a very good sign. It shows buyers entered with full force. Let me show you an example of a trend reversal. Let me find it here. Let's say the trend changed from here. Okay, trend reversal happened. Now let's draw its trend line. We have a low here. Let's draw the top two. From here, it gives us this top. Sorry, from here, and it gives us this top. Where did the trend reversal happen? Exactly after this break here, right after this break. Before that, it had already made a lower high and lower low. After this break, after this candle chart closed below that low, we could have opened a short position. If we had entered there, set our stop loss above this high and targeted here, this would be our target, 35% gain and 8% stop loss. That means a reward/risk of around 4+. So you see, with just one simple trick, you could make solid profits because trend reversal is one of the most important concepts. And literally, the only two things that form the market are candles and trends. That's the takeaway. And here you can see that at the same time as that break, volume also increased, which is a very good sign for selling. Of course, that's the ideal case. Even if volume doesn't increase, you can still open a position, but you'd have one less confirmation. What do I mean? I mean, your confidence level is a bit lower. This is the ideal situation, but it doesn't happen every time. Now let me tell you one more thing to help you open even better positions, because I want you to take all this knowledge I've given you, combine it with your own thinking, and get the best out of it. Look, we're in an uptrend forming higher highs and higher lows. Then suddenly we form a lower low. Personally, I don't enter a position here. Why? It broke this. It broke the previous trend line, but I still wouldn't open a trade here. I wait for one more confirmation, a lower high, because in a downtrend, we need lower highs and lower lows. And here we only have the lower low. We don't have the lower high yet. Once that lower high happens, and then it comes and breaks the low again, that's when I open my position. Sometimes though, the reverse happens. We're in an uptrend and suddenly we first form a lower high. Well, that's better because after it breaks the low, we can open our position and we won't be late to enter. We'd open the trade right at that point, set the stop loss above the previous high, and we're good to go. This was another tip I wanted to share to help you open better trades. If there's anything you didn't understand or if you have any questions, feel free to ask in the comments. We'll reply right away. That's all for now, and be careful of dream sellers. Don't fall for their tricks, just to sell you their book or course. Everything I'm teaching you is free because all of this is already available online for free. It just takes some searching. Beware of dream sellers. It's a long journey, just like any rewarding path. It takes effort, but after a while, you'll get into it. And while it's hard, it becomes enjoyable, and you'll finally reach your income and goals. They say it takes 3 years of effort before you can truly call yourself a pro trader. But think about the income. Think about how sweet the end of the journey is. I love you all until the next video and the next analysis. Goodbye.